On today's hot sheet, I'm discussing yesterday's FOMC meeting and Jerome Powell's comments on housings, along with weekly unemployment data. Today is Thursday, March 21st, 2024. I am Byron Lazine, and the hot sheet starts now. Good morning, and thank you to all of you who joined the live stream here on this YouTube channel, or we actually did stream it as well on the Knowledge Brokers podcast live tab. We had over 10,000. I think when you include Knowledge Brokers pod now, over 11,000 of you already watch it since 3:30 p.m. yesterday. Thank you so much for being a part of that. If you missed it, definitely take some time here at the end of the week or later this weekend to check out the replay. It will remain on our YouTube as well as an upload into BAMX for those of you that access into BAMX. All right, let's get into the big day yesterday because Jerome Powell spoke at 2:30. Then we did our live stream at 3:30. In fact, Lambert put out just one of the most hilarious tweets of all time. Friend of the Knowledge Brokers podcast. Of course, we've had him on there. He's a supporter of BAM. We love we're a supporter of Resi Club in reverse. We love what Lambert does for the housing community. Of course, I use a bunch of his stuff here on the hot sheet. Not every day, but almost every single day. As often as I can use Lance's stuff, I do, because it's just great quality stuff. For former editor of Fortune, of course, and now running Resi Club. But check out this tweet that Lance puts up yesterday. I was actually trending there for a moment in a mini housing world. Jerome Powell speaks at 2:30 following FOMC decision rate. And then bam, here we were talking about the NAR settlement at 3:30. Must viewing yesterday. I'm sure most of you, though, didn't have the time or the chance to view Jerome Powell. So what we do every time the FOMC meets, makes a decision, and holds their press conference is we break it down right here for you. We do that every single 45 days or so when they meet. What you probably already know is the punchline. Today, the FOMC decided to leave our policy interest rate unchanged. This is the opening statement here from Jerome. And to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation as labor market tightness has eased and progress on inflation has continued. The risks to achieving our employment and inflation goals are moving into a better place. So that's the punchline. There's no movement yet on the Federal Reserve overnight target interest rate, okay? When we go to the actual statement here, okay, this is the press conference statement. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. You hear that throughout almost every time Jerome Powell speaks. You heard it yesterday during the Q&A session. You heard it just within the last week or two when he was in front of Congress and all of his testimonies there. This continues to be the line that he stands behind. Why? Because it's the mandate that Congress gave him. If we want Jerome Powell and the Federal Reserve to do other things, that would have to be mandated by our elected officials. Okay, famously, there's the quote from Rand Paul years ago that says, the Federal Reserve isn't even in the Constitution. Yet our elected officials obviously support the Federal Reserve, and the mandate is clear, and it is this. It's maximum employment while creating stable prices for the American people. Anything counter to that is not what Jerome Powell is going to pay attention to. So the affordability of homes, the home ownership rate, doesn't care about either of those, cares about the short term, which is stabilizing prices and holding maximum employment during that time frame. So they decided overwhelmingly, I think it was a unanimous decision here from the FOMC, the committee, to hold rates steady. Okay. Now, with that, they've maintained that there will be 3 cuts coming later this year. So we should expect to start cutting. And when we do cut, you can expect more cuts to follow. If we look back on going all the way back 20 plus years, the federal funds target rate from July of 2002 today, you see here in the early 2000s after the dot-com bust in July 2000, the federal funds target rate was actually higher than it is today. It was 6.5%. When they started cutting on December, or I guess January was the first cut, January 8th of 2001, they went down to 6%. Okay, so they did 50 basis point cut on the first cut. And then by the end of 2001, November, they were all the way down to 2%. I'm not saying that that's going to happen here. Jerome Powell's not saying that that's going to happen here. He's saying 3 cuts this year. But I'm just showing you how quickly the federal funds target rate can be cut. Certainly, if we went into a recession, again, not saying that that's going to be the case, but if we went into a recession, you would see their actions be larger than maybe folks are anticipating, and certainly a lot faster. By July of 2003, so essentially 24 months later, the federal funds target rate was all the way down to 1%. Of course, in 2004, and by middle of 2004, when we were in one of the hottest real estate markets of all time, they started to increase the federal funds target rate. And you see that by 2006, it was up to 5.25. Okay, so a couple of years, it got up to 5.25. Not as steep or dramatic as a climb as we just experienced here in the last couple of years. But they stayed at that number for quite a while. Okay, 5.25 all the way until you see the first cut there was in October, late September rather, of 2007. Of course, we were going into the great financial crisis, and the decline happened rapidly. We went all the way down to essentially a 0% interest Fed funds target rate. That would be on December of 2008. We stayed there forever, it seemed, until 2016, when we started to step up the Fed funds target rate. Got as high as 2.38 in 2019. If you remember, late 2018, people thought the 30-year fixed was high because it was higher than it had been the years prior. It got as high as 5%, and people started to freak out. The market took a little pause just because we were so spoiled during the 2009 to 2016, 17 years of what was then considered all-time low 30-year fixed mortgage rates. 2018 got a little high, and then this cut started coming, and of course they happened dramatically in 2020. March of 2020, we went back down to 0% interest rates, which brought on the lowest 30-year fixed rates of all time, which are unsustainable, unreasonable, not healthy for a housing market to have 2 and 3% 30-year fix. And now today, we have what we have here, which is the rise of the Fed funds target rate and the rise of the 10-year and of the 30-year fixed. This is how the Fed funds rate increases since 2022 look, from March 2022 all the way until June of 2023, May of 2023. Every meeting, the FOMC increased the Fed funds rate. In June, July, September, and December, those were 75 basis points. Okay, May and December on each side of that 4-month stretch, the increases were 50 basis points. Now since September, since really July, when the last time they raised, we've seen no increases on the Fed fund target. That being said, Jerome Powell is saying that we should expect 3 cuts sometime this year. Didn't give really any indication that would happen on the next meeting. Didn't really give an indication of when it would happen. Obviously, if you're counting the meetings, we can go and just take a look here when the meetings are coming up. Here's the calendar. Okay, so 2004 FOMC meetings, 2 of them are in the books, January's meeting and March's meeting. They have now 6 meetings left with 3 cuts to go. Okay, there's a lot of folks targeting June as maybe that first time that they actually cut. There's a little bit of hesitancy to say that, hey, it's going to happen in April and May. You could, there's also a theory here where you could see one in April, May, see how it goes, a pause in June, then another cut in July, potentially a pause in September, and then one potentially in November. Then there's some theory out there that they're going to try to get these stacked up, obviously, before a critical November, which includes a presidential election. We don't know what's going to happen. All of that is speculation. We do know what Jerome Powell is telling us, that we should expect 3. There's 6 meetings remaining. Okay, so expect 3 cuts coming into the future. Going back to Jerome Powell's statements here, another thing you're going to hear a lot from Jerome Powell is this line that you've heard over and over again: we're fully committed to returning inflation to our 2% goal. That hasn't changed. Of course, they decided to leave the policy interest rate unchanged. Recent indicators suggest that economic activity has been expanding at a solid pace. That's been something that's been a little bit of a shocker to some. The GDP growth in the fourth quarter of last year came in at 3.2%. That's a huge number. For 2023, GDP as a whole expanded 3.1%. These are big numbers. They're expecting more GDP growth. They generally expect GDP growth 2.1% this year and 2% over the next 2 years. So they actually revised up their growth projections since December, did the committee. So they're anticipating the economy to continue to grow, continue to be strong, and continue to be robust. Now, what did they say about housing? Okay, let me jump in here and take you through the show notes. By the way, members of BAMX get access to this each and every single day that we have the hot sheet. And today's hot sheet show notes are particularly interesting because we give you the timestamp of all 5 moments when Jerome Powell actually mentioned housing. There were 2 in the prepared statements, which I'll go over now. And then there was 5 timestamps when Jerome Powell went through the question and answer. We'll play those for you. You're able to use this as well as everything in the first segment and the final segment in your marketing. All BAMX members get access to this each and every single day. We have a hot sheet show. And if you're not in BAMX now, you can use code MADNESS, 20% off to get access to that. Okay, in the opening statement, less than 2 minutes in, Jerome Powell made the statement that he's made before. Activity in housing sector was subdued over the past year, largely reflecting high mortgage rates. Not many can argue with that. Then, just over the 4-minute mark, Jerome Powell said the Fed's monetary policy actions are guided by our mandate. That's the mandate I talk about from Congress, to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. Oftentimes, for those trying to make ends meet at the lower and how does he put it? He probably puts it for those least able to meet essential needs. They tend to get hurt the most. I might be thinking of a proposed settlement, a proposed NAR settlement that is in reaction to one of the largest lawsuits of all time. Who's going to get hurt the most? First-time home buyers, right? But oftentimes this is what happens when these large scale policies are made, that the people at the bottom get hurt the most. And Jerome Powell is acknowledging that, hey, to get inflation down to 2%, he's recognizing, the committee's recognizing that people at the bottom, unfortunately, are getting hurt the most. It's unfortunate. Okay, 10-minute mark. Once we get into the question and answer segment from the FOMC press conference, 10-minute mark, Rachel Siegel from the Washington Post posed a question. Let's go to the video and get the question, Powell's response. There's a follow-up from Rachel, and then I'll give you my reaction to that. We will bring it about.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
And will you be able to get overall inflation down to target if housing doesn't break through quickly? And does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Okay, so there's a question, answer, follow-up question, answer from Jerome Powell and Rachel Siegel. Unfortunately, that was only one of two questions asked during the Q&A segment about housing, so kind of a light Q&A session here in regards to housing. I think the last time we did this, there's maybe 4 or 5. You can go back to the show notes and take a look. But if my memory serves me correct, there was a lot more questions from the press last meeting, not as many this time. Now, the one reaction I have here is Jerome Powell talking about there's a little bit of uncertainty about when that will happen, talking about when these lower market rent increases will start showing up in inflation, and uncertainty about the exact timing of that. Well, a lot of that has to do with owner's equivalent rent being weighted so heavily in the CPI. It's a made up number. It's what homeowners do, taking a survey and coming up with a fake number of what they would rent their house at. And so that, to me, kind of elevates this inflation quite a bit. Now, if we look at where rents are trending, they're trending down in most parts of the country. My sister, for example, who's the senior editor here at BAM, she's shopping in the East Coast of Florida right now. Her and her husband are relocating from Connecticut down there for a job transfer that he has. Okay. And as they look at apartments, because they're going to rent first, they're seeing an abundance of inventory. And some of these prices are coming down from where they were just recently. Some brand new buildings are being competitive with offers to obviously entice renters. You're seeing that in a lot of parts of the country where there was an oversupply of multifamily being built. Of course, there's going to be other parts of the country where rent prices are still holding firm and not moving down, but they certainly aren't accelerating at the 16% that they did during the pandemic. So I think we can suggest that, when we look at overall inflation, housing driving the majority of it, we can see into the future that this will come down significantly. And hopefully Jerome Powell and the committee take that into account over time here as they decide when to make that next cut. Let's go to the next question from Michael McKee. Bloomberg Radio and Television has kind of a little bit of a question here for Powell.
Michael McKee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying, we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now, and we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bump.
You can drop it off. I have the transcript in front of me. They never get back to the second part of Michael's question, so I will give you the answer Jerome Powell has given in the past on this. I'll just address a couple things he did mention about inflation. I think it was pretty obvious at the beginning of the year that there was going to be some bumps in the road. He talks about the recent bumps with some of the hotter inflation data that we've seen. This is why, as real estate professionals, I would stay far away from saying we're going to see 5% interest rates. Just yesterday's hot sheet. If you missed yesterday's hot sheet, you can give it a replay. And you can give it a replay not only here on YouTube, but on Apple and Spotify. If you're listening on Apple and Spotify, I'd love for you to leave a review on either of those two here for the hot sheet replays. Thank you so much if you're willing to do that. But yesterday we showed Fannie Mae's updated projections now for the 30-year fix being up over 6% here for the rest of the year. I just saw way too much content coming from real estate professionals in January and February talking about 5% 30-year fixed interest rates. I don't expect it. I've got the over on 6 3/8 for the year. And it's because of the bumps in the road. And obviously sitting here towards the end of March, that bet looks pretty good. Now, the question that wasn't answered, and I wish Michael McKay, when he followed up, said, can you answer the second part of my question and also have a part 2 follow-up? And then he could have asked the question there he asked about inflation. But, he says, housing prices, do you expect them to go down? And they don't go down. The expectation would that home prices would go down with the increase of the interest rates. Well, because of the lock-in effect, which we also talked about on yesterday's hot sheet a little bit, prices haven't gone down because of the issues we have with inventory. When you just starve inventory out of the marketplace and there's still some demand there, albeit less than there was last year, you're going to keep seeing prices go up. It's just common economics. And Jerome Powell has stated over and over and over and over and over again, and maybe that's why he didn't answer the question, because he's just answered it too many times. Nor he, Jerome Powell, head of the FOMC, nor does the committee care about house prices. They don't care if home prices, the price to purchase a home, goes up 50%. They don't care. I'm not saying that they will. I don't think anybody's predicting that, obviously. They don't care if it goes up 10%. They don't care if it goes up 5%. They don't care if home prices go down 10%. All of it's irrelevant to them. What they want is inflation to go back down to 2%. You can have rising home prices and inflation go back down to 2%. Well, how does that happen? Well, one way that happens is rent prices come down significantly. More people choose the option to rent than to buy. This is why there's a lot of people get angry when people say, hey, the government really doesn't care about home ownership. They want to see a renter nation. If more people were to rent right now, rent prices come down and it brings inflation down to 2%, yet home prices go up 50%, nobody's going to care Okay. The Federal Reserve certainly doesn't care. And Jerome Powell said this before, doesn't care if more people can buy a house or not. The mandate from Congress is to sustain prices. Sustaining prices in the short term means, can you get a rent that brings inflation down, that helps bring inflation down? And if you can get a rent lower than home prices, Jerome Powell's advice would be go rent. And can you get goods and services prices to come down and maintain employment? That's the Federal Reserve's position. Okay. Love it, like it, hate it. That's their position. They don't care about long-term home ownership rates. If Americans are going to have the ability to build wealth while renting, or if they have a better ability to build wealth while sustaining home ownership. That's just the facts of the mandate from Congress, from our elected officials to the Federal Reserve. And Jerome Powell he's by the book. I mean, I don't know a better script articulator than Jerome Powell. If Jerome Powell was a real estate agent and you gave him a script, he'd be a machine. Give him a phone and a script, he would knock out appointment after appointment because he sticks to the script. And the script has been mandated, obviously, by Congress, and he's not veering from it. All right, we had some unemployment insurance weekly claims also released as of this morning at 8:30 a.m. The week ending March 16th, seasonally adjusted initial claims dropped by 2,000 to 210,000 compared to the previous week's revised level. The 4-week moving average for seasonally adjusted initial claims rose to 211,250, indicating a slight increase of 2,500 from the previous week's revised average. Overall, unemployment is really not an issue that's on the table. Unemployment would be one of those issues that could drive the 10-year down and the 30-year fixed down, but it also increases the possibility and potential of a recession. So not rooting for that just to get the 30-year fixed down, but the job market's very strong right now, and there's no signs of that happening. The highest insured unemployment rates, U.S. metros, would be Jersey, Rhode Island, California, Minnesota, Massachusetts, Illinois, Montana, New York, Pennsylvania, Alaska, Connecticut, and Washington have the highest insured unemployment rates right now in the country. There's your top 12 straight out of your BAMX hot sheet show notes. The largest changes in initial claims, you've got Oregon, 1, California, Indiana, Texas, Nevada. Those are the largest increases. The largest decreases would be New York, Ohio, New Hampshire, Massachusetts, and Vermont. That's your update on unemployment here for this week. Again, encourage you, if you missed the Knowledge Brokers panel that we did yesterday right here on the main channel, on the YouTube channel, as well as in the live tab at Knowledge Brokers podcast channel. You can go back and take a look at that. Already 11,000 plus have viewed that. Thank you so many of you who have viewed that video, obviously, who joined us in the BAMX after party. The BAMX after party, if you missed that, there was some phenomenal discussion there. That's up for replay in the Facebook group, as well as it'll be uploaded into the BAMX platform. You can go check that out if you missed it. If you're missing out on the BAMX stuff, like today's hot sheet show notes, Madness, code Madness right now gets you 20% off. I think code Madness will be running here for a little bit over the next few days, so you can utilize that to get 20% off of your BAMX membership. Let's take a quick look at the 10-year. And 10-year was down yesterday a little bit off of Jerome Powell. Here's the last 5 days. We're on a downward trend, at least on the 10-year Treasury. We're at 4.277, still over that 4.25 mark that we kind of been watching to hopefully stay under. Here's the last day. We kind of had a little bounce back up. We got under the 4.25 early this morning, and then have bounced back up since that time frame here. I don't know if that's a market reaction. Market's up, S&P's up, NASDAQ's up. So markets are up here to lead off this Thursday. We ended the day yesterday at 7.03, the fifth consecutive read over 7% on the 30-year fixed. And, hopefully we'll get that to drop back down into the high 6.9s. That Walmart number of 6.99 sounds better than 7.03. Still essentially a 7% 30-year fixed rate if you want to keep it real, which we always want to hear. It's your hot sheet here for the week. Outside of any breaking news tomorrow, we won't go live, but we will have an At Knowledge Brokers podcast tomorrow over on the Knowledge Brokers podcast channel. Maybe Haley can drop in the link to that YouTube channel for those of you who have not subscribed over there. Myself, Tom, and Lisa will react to the panel that we did yesterday, and we'll cover this week's top news and how to react and use that in your business. So at Knowledge Brokers podcast tomorrow, that new podcast we do each and every single Friday. I encourage you to check that out. Thank you guys so much. It's been a great week with you all. I will see you over there at Knowledge Brokers podcast tomorrow. And of course, on the hot sheet on Monday, 9:30 on the East, 6:30 on the West. You know the deal in between. Until then, toodaloo.